we have a very special presentation from a very special man. This man is a warrior, let me tell you, and he is a warrior from the trading pit. And today he is going to share the war stories from the trading pit. He will come to you in full camouflage uniform. Let's make very welcome Nick Radge.
You think I'm kidding? This is the jacket I wore for 4 years. I still wear it around town now. My introduction to the trading floor was pretty much by accident, as was my entry into the industry, but I was called down to the trading floor. I used to push paper around in the back office, and I was called down to the trading floor on one very nasty day in 1987, and I had absolutely no idea what was going on. There's a lot of yelling, a lot of screaming, a lot of this going on, a lot of mayhem, and I just remember the spy pit would open about an hour and a half after the interest rates. So the interest rates that normally move 2 or 3 points a day were moving around 50, 60, 70, 80, 90 points. In fact, a lot of people went bankrupt, not from the collapse in the stock market, but from the movement in the interest rate futures at the time. But when the SPY futures opened, everyone just went dead quiet. Now, normally the SPY futures, they would make a 1 or 2 point spread, and they were negotiating amongst the traders in the pit what spread, what bid offer spread should they trade in, and they decided they'll trade in 50-point spreads. Now, back then, 50 points, it was $100 a tick. So it was $5,000 between the bid and offer spread. And within the first 2 minutes, this thing has just moved like 300 points, 400 points this way, and back that way. And about a minute later, security guards came in and removed all the option traders. And of course, for the last 5 or 6 years, they had been short selling put options, peanuts in front of the steamroller, and the steamroller had arrived. Now, all these guys were bankrupt, but there was no point them stopping trading. They couldn't lose any more. It was gone, so they just tried to get themselves out of the hole. So the security guards were brought in to remove them so they didn't collapse the whole financial system. Here is the trading floor. I've had the pleasure to work on quite a few floors, or be on a few floors around the world. Sydney, obviously, for 4 years or so. CIMEX, which is the Singapore Exchange. London, the London International Financial Futures Exchange. And I've had the pleasure of going on to the Chicago Mercantile Exchange, where they trade interest rates in the mini S&P, or the S&P as it was back there. And then the beast of them all, the Chicago Board of Trade. And that there is the 30-year Treasury bond pit. And they're all trading the same product right there. And it's quite well organised. You wouldn't think so, but it is quite well organised. And the organisation structure in the pit, this is an overhead shot. And the organisation structure in the pit, and I'll explain the way it is in Sydney, but you can see the different coloured jackets there. So right in the middle of the pit, in Sydney, for example, you would have 2 people. You'd have the SFE officials, and back in the day then, they would have a headphone on, and they would call the prices and the volumes up to a level just above us, and the girls would be plugging it in the machine. So it was all done manually like that. So the SFE officials would be in there, and there was quite a few of them because there was a lot going on in the pit. And then you'd have the pit boss, and he was the one that would try and keep calm everyone. You're all a bunch of overpaid 20-year-olds. And of course, they just copped absolute sledging all the time. Then the next round, so they would be in the middle, and the next people in the middle were the locals. So locals would be working for themselves. They would be trading their own money, trying to profit from price movements, and they would be in the middle. They were down in the middle, and they would look up the pit and they could see what was going on around them. And the reason why they were down in the middle, because on the outside of the ring of the pit were what's called the paper fillers, and these were the brokers. And the team I was in, there was 4 of us. When it got really busy, there would be 5 of us. We had one of the biggest teams down on the trading floor. We were one of the biggest paper fillers down there. I worked in the bank bill pit, and so there was 4 of us in this particular team. 2 of them stand at the front looking out into the pit were the traders themselves. Then they would have a backup that would stand behind them, and that's the guys in the yellow jackets. So they're actually the clerks that are standing behind the paper fillers. And it's their job to take the orders from the people standing up in the grandstands. They're signalling the orders down. The clerk would take it, whisper it into the trader's ear, buy 100, sell 100, sell 200, buy 500, whatever it may be. And that just went on all day. So that trader would be trading with people around the pit. And the reason why we've got these coloured jackets is so you would know that you're trading with certain companies. So everyone stood in the same spot every single day. In fact, the Chicago Board of Trade and the Chicago Mercantile Exchange, they used to pay for the locals to have the best spots. These are the people playing with their own money. And they would pay a kid from high school to come and stand on the spot 3 hours beforehand every single day so they could have that spot. Why did they want that spot? Because standing behind them would be a behemoth like Goldman Sachs or someone like that. And when you wanted to move volume in and out, you wanted the biggest bloke in the pit right beside you. You could turn around and go buy or sell like that. So it was a very prosperous investment, if you like, to pay a kid to stand there until you got on the floor, because bugger if you were going to stand there. So that's basically the hierarchy. The brokers around the outside on the phones are on the phones to their clients or trading desks upstairs. The orders would come down via phone. They would send them in via hand signals into the pit to the clerk. The clerk would say to the trader, buy or sell, and off it would go. So let's have a look at those hand signals now. There is a science behind it. It's actually pretty easy to do. So we're going to go through that now. So there's two ways to do this. Buying, and the secret is when you're buying, your hand faces in, right? You're buying something, you're taking something. So when you see one of these trading places videos and their hands are facing in, they're a buyer. They're buying, they're taking it. Hand facing out, you're a seller, you're giving it away. So that's immediately when you're looking around the pit, you can see, well, he's a buyer, she's a seller. You can see around the pit simply from which way their hands are facing out. And that's why they're standing in the pit all the time with their hands facing in or out. So when you buy, the price is out in front of you and then the volume is on your face. Okay? So when we're talking prices, we're just talking the last decimal point. So I was in the bill pit, 2 decimal points, and it's always the last decimal point. So it's last price, so 1, 2, 3, 4, 5. What would 6 be? No. 6, 7, 8, 9, and 10, or 0. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 0. That's your 10 decimal places. What's 11? It's not going to be 1, it's going to be 11 or 21. So it's just 1. 2, 3, 4, 5, 6. So that's the price when you're buying, and then the volume is done on your face. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 20, 30, 40, 50, 60, 70, 80, 90, 100, 1,000, 21, 22, 23, 24, 25, 26, 27, so on. Easy, right? So that's when you buy. So you'll get an order to pay 2 for 100, you stand in the pit, you go 2 for 100, 2 for 100, 2 for 100, and you stand there 2 for 100, 2 for 100, until someone sold you 100 or the bid went higher, okay? So when you're selling, it's the opposite. Hands are facing out, you're doing the volume on your face and the price out in front of you. So again, we're selling 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 20, 30, 40, 50, 60, 70, 80, 90, 100. So you're going to sell 95 at 67, so it's going to be 95 at 7. Simple as that. So if you're on the bid and the offer, you'll be going 6 for 100, or 6 for 100, 50 at 7. 6 for 100, 50 at 7. And you'd be doing that all day. And in your ear, you've got this little kid behind you going, sell 100 at 6, pay 7 for 100, sell 100 at 5. It's like, oh my God, what's going on here? So the order system also includes stop losses, GTCs. So a stop loss, for example, let's say the market is trading 5 and 6. What these guys are doing is they're reporting the prices, because it's so loud, you don't know what the prices are. So they're currently saying, so you see the guy's got a closed fist. It's obviously a 0. Something's at 0. You see a couple of the guys have got fingers going like this. So that's a half point. So what they're trading there obviously trade in halves. So it'll be 1.5, 2.5, 3.5, 4.5, 5.5. that kind of stuff. So that's what they're doing. So they're reporting the prices back. So let's say you get an order. Let's say the market's trading 5-6. So these guys will be just sitting here going 5-6. Sometimes they'll be telling you the volume that's been at the price. 5-6, 5-6, 5-6. 6 trading. 6 trading, 6 trading, 6 bid, 6, 7, 6, 7, 6, 7, 7 trading, 7 trading, 7 bid, 7, 8, 7, 8, 7, 8, and away it goes, backwards and forwards, backwards and forwards. So let's say the market's trading at 5-6, 5-6, 5-6, and you get an order to pay 7 for 100 on stop. So the order would be 7, pay 7 for 100 on stop. And you'd write that in your order pad. So 6, 7, 6, 7, 6, 7, 7 trading, execute your stop. Bang, and away you go. Let's go. Ready? Now, it's also very handy when you're at the pub. Because, of course, beside the Futures Exchange was the Brooklyn Hotel. Friday nights it was pretty busy. Someone's up at the bar. I'll have 10 beers. Away you go, right? So that's the hand signals. Pretty good, eh? Very easily done, global. Everywhere in the world, the exact same hand signals for everything. So all sorts of orders will come down. And you would confirm the trade. So if you're trading with someone on the other side of the pit, you couldn't hear them because it was so noisy. So you just go, check, I sold you 100 at 6, yep, and you write it down. So the way it gets reported to the market is you've got the pit guy, and he would be seeing you. So just to reiterate what goes on there, so there's 2 teams. You've got the spot trader, which is the main trader. He is trading what's called the spot month. That's the month that trades the most volume. So when you go and look at open interest, for example, and the E-mini futures, you'll see that currently, what are we, July, with the September contract is currently the spot contract. That trades 80% of the volume. Then you would have distant months. And as Chris mentioned out there before, the bank bills go out for about, 4, 8, 12 months out, 3 years out. So the head trader would only trade the spot month, and every broker in the pit would all have the same guy that trades the spot month. So if you're trading the spot month, you're going to be trading with that guy and not the guy standing next to him with the same jacket on. Okay? You would get to know who's trading the spot month. Even though the guy beside you is trading the same price but in a different month, you wouldn't be trading his price with him because he's trading different months. So the other guy in the team, he's trading all those other months. So he'd be trading 12 different months. But they don't all trade the same, okay? The spot month, he's doing the majority of the volume. The other guy's doing that. Now, Chris also mentioned before, you're trading spreads, okay? So you might be buying the March. Oh, that's the other thing I forgot. So the months, you're trading different months, hand signals for the month. So that's March, June, Sep, and Dec. So let's say I'm the trader number 2. I'm not the spot month trader because we don't have to tell him what month he's trading. He's trading only 1 month. But say I'm the second trader and an order comes in and I want to trade Dec. So the broker's going to say, in Dec, pay 2 for 100. Or in Sep, pay 1 for 55. And then there's spreads. What happens if you get someone who wants to spread? Do a Sep Dec spread. So in the Sep Dec spread, pay 2 for 50 or 2 for 100. So the way we managed it, these order tickets, these are trading cards that I used to use, and you would have a pack of them. And there was 3 uses for these trading cards. 2 were official uses and 1 was unofficial. The official uses was 1, you would have an order card, and it would hold all your orders. And you'd have all your buy orders down one side on the left-hand side at the bottom and all your sell orders on the right-hand side at the top of one card. And it would just sit in the front of all those cards. And you would just be holding those cards freely in your hand. And you would just be looking at those orders, and it would be natural flow. So when another order comes in, unless it was executed straight away, it would just be added to the total. So you might have a 7 bid for 463, you'll get another order to pay 7 for 100, you just adjust that and so on and so forth through the day. And that would just get pretty messy eventually, and you'd have to rewrite the whole thing when it quietened down. Then when a trade is done, whether it's a buy or sell, as per these cards, you would write down, if the order was done cleanly, like for example, say you had 100 to sell and you sold 100 to one particular person, you just write that person's details down, the price and all that kind of stuff, and that would go into this pocket. And then a lovely young lady would creep up behind me, put her hands in my pocket, take all that kind of stuff out that got jammed in those pockets. So the trading cards would go into one pocket, and then we had a thing called trading chits. So a trading chit is a ticket that the seller would write, and it would be in triplicate. The buyer would get a copy, the seller would get a copy, and the exchange would get a copy. So the seller's job when they got time was to write that chit, which had all the details of the trade, give the other side their copy, and that copy would go into my pocket, and then they would actually have to physically go and put the SFE version into a box that sat on the side of the room, and the SFE would collate those. And then, again, a girl would come along, she would take that out, and she would go back. If it got really, really busy, the clerk would write all the chits for you. You didn't have time to actually do that. So the two official reasons for the cards are to keep a track of the orders that you're working and also write the orders out that you've executed in the pit. So there's a third unofficial use for these cards. And it happened once that I saw after lunch one day. Remember, the SFE used to close for an hour and a half for lunch. People would just go straight next door to the pub, and of course, it would just be an absolute shit fight in the afternoon, especially if it had been quiet. And the worst times were when it had been quiet in the morning and people were expecting it to be quiet in the afternoon, but someone's made a comment, the market goes crazy, everyone's drunk, it's not a good look. And the one things we found out with these cards is when you throw them, they stick together like a brick. So the head trader that taught me, his nickname was Gripper, and that's another story. No one called anyone the same name. Gripper was prone to having a few drinks, and he had the shits with Zulu on the other side of the pit, and he threw his cards, and instead of them going whoosh, they just stuck together, went straight across the pit boss, and hit Zulu smack in the head. And he got a fine for that. Front running. Front running is kind of like insider trading. You know, someone's got an order, you want to jump in front of them. A guy got jailed just the other day, actually. He hacked into the computers of Port Phillip Publishing, one of the biggest newsletters in Australia. He hacked into the computers, got their trade recommendations before they published them, and was front running them. And apparently he made $400,000 in a small amount of time. An ASIC got onto it, and he got jailed. But front running on the trading floor is actually pretty easy. And a lot of people made a lot of money from front-running orders. It wasn't good etiquette to do that, and if you did it, you weren't banned or anything like that, but the one day you wanted to get out of a trade and that person you front-run is your way out, he's going to go, yeah, no, like that. So it was just etiquette not to do it, but it certainly happened. So the obvious way it happened, and there would be some expletives and some threats and all that kind of stuff when it was that obvious, but the pit is round. All the orders coming into the pit are coming from behind. So if I'm facing the pit, the orders for me are coming from behind. But the guy standing in front of me can see the hand signal coming in. So if he sees a big order come in, he's just going to go, oh, sell, 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 and front run me because he knows I'm going to have a big order. When you get a really big order, which we'll talk about one in a minute, the broker would actually come down and whisper something in your ear, and everyone would just be standing there waiting because they know something big's going to come, but they don't know which way it's going to be. And Gripper would just stand there, and he'd look around the pit, and he'd just go bang, 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 and start selling all the orders, selling all stuff. And the mathematics behind it was pretty simple. It was just a process of learning different number combinations. So say, for example, I get an order to sell 500 contracts. You might have 27, you might have 13, you may have 86, you may have 150, you may have 200. And the gentlemanly thing, the etiquette thing to do was to dish them out evenly. If you just went, I'll sell you 500 over there and forget everyone else, well, that's going to be returned to you one day. So the best thing to do is be nice about it. If the market was really busy and you had to unload a lot very quickly, you could kind of go, right, I'll sell you 250 over there, and that would just set everyone off. And then you go, right, I'll sell you 13, I'll sell you 30, and you'll be writing them down, and you just add them up in your head until you got to 500. And every so often you'd sell too many or buy too many or whatever it would be. But this front-running story, I'll try and not say their names because they're both still alive. I'll Funny how I put HSBC up there as front running. But what happened once on the trading floor, and it happened in the 10-year bond pit, and it probably happened in a lot of other places. To give you an idea of the potency of front running, there was a guy in my pit, and he was about 24, and his first year of trading for himself, I think he made $900,000, which wasn't bad back in 91 or 92. And he was only doing it because he could see these orders come in and he was just slowly shifting off and doing that kind of stuff. Anyway, but this one, what was going on? So, in the 10-year bond pit, now there's two people who are on the floor in this room and you'll know who I'm talking about. So she was a local. In other words, she traded her own money and she stood in the middle of the pit. He, her boyfriend, worked for one of the biggest paper fillers in the 10-year bond pit, and he stood right behind her. So she was here facing in and he was behind her. His orders would come in and he would just give her a little tap on the left leg or the right leg if he was going to be buying or selling a big amount of shares. And they had some other signal that if she had a position and he was going to wipe the slate with her position, that he'd quietly say, you better get out. And what they got caught eventually, and the way they got caught is one of the guys on the other side of the pit saw the order come in to this particular paper filler and he sold the wrong amount. And the guy on the other side of the pit goes, no, you sold the wrong amount. You've only sold 400, you're supposed to sell 500. He goes, no, I've done the 500. No, you only sold 400. No, I've done the 500. And this happened about 3 times until it got reported. And it turns out that he was quietly giving her some of the trade and no one was picking it up. But the guy on the other side of the pit didn't realise that was happening, but he could see these anomalies going on all the time. So they both got pretty well badly fined. The old fat finger. You even see this today, but back then, this was still when we were pit traded, but the New Zealand Futures Exchange was actually one of the first computer trading platforms out there. And we had a client that always executed market on close. And one of the guys that used to work with me, Stewie Martin, it was his job to execute these orders. So we had to go back up to the office, wait for this Kiwi market to be within 1 minute, and then execute these orders. Now, it was the day before the election, which was a Saturday. It was a Friday night. It was a Saturday. It was the day before the election. We got a normal order that came through. It was about 200 contracts. And Stewie sat down and he accidentally put in 2,500 or something like that. And once you release the order, it just goes. Now, again, the New Zealand market only moves about 4 or 5 points in a day. And this massive order went right in within 1 minute to go. And it's driven the market about 50 or 60 points down, executed, filled 2,500 contracts. And I just remember Stewie going, fuck. And he physically couldn't talk. And I'm sitting there thinking, whew. And it's the election. We can't exactly hold the position overnight. There's no way to get out. There's nothing to hedge it against. So we go, right, let's ring all these counterparties that we've sold to. And we'd ring up, we'd be ringing people like Westpac. Oh, yeah, sorry, no, I can't let you off that trade. You know, because they've just made so much money. All they have to do is hold it over the weekend. And we're ringing. No one would let us off the trades whatsoever. And then BT rung up. And BT said, oh, you guys got a problem? And we said, yeah, Stewie was a bit more expletive-ridden than that. But he was saying, yeah, we've got a problem and no one's letting us. He goes, all right, we'll take the whole lot. And it's like, what? And they said, we'll take everything you've sold. We'll take whatever you don't need, whatever you can't get rid of, we'll take the whole lot. And Stewie's just gone, oh my God, how good is this? And then about 20 minutes later, an announcement came out, something big with the election, and the market just went, on Monday morning, it gapped about 150 points down. So all these other guys from Westpac are ringing up, yeah, we'll break that trade, no problems at all. It's like, sorry, it's all gone. You all know this guy, George Soros. So when I worked in London, the dealing room I worked in over there had 1,000 traders on it. It wasn't the trading floor, it was actual HSBC dealing room. And this was just after George Soros broke the Bank of England, so he was at the top of his game. And the little dealing desk I was on was segregated from the big dealing room, but they were just outside our doors. It was open. Anyway, straight outside our doors was the FX desk, and there was about 450 guys on the FX desk. And the way it worked was a big order would come in and they would distribute, because they were market makers, they were price makers, and they have to distribute that out to their clients. So one day there was all this noise going on, and I've stuck my head out there, and old George had rung up with this monstrous order to sell some currency. And the way it worked is one guy took the order and he goes, yep, we'll take your order and we'll give you a price. Now, when they give you a price, you don't know if he's going to go, yeah, I'll sell you that price or I'll buy that price. You don't know what they're actually going to do. So he's made the price. He didn't know the size. He just made the price. And George Soros goes, yep, I'll sell that. And this guy stood up, and a clerk beside him punched in some numbers, and a big screen had this number, the size of the order comes up on the screen. And the guy stands up, and you've got like 1,000 people dead quiet in the rest of the dealing room, and they're getting on their phones and ringing their clients trying to get rid of this trade. So they're all ringing up. So it might have been $1 billion trade, for example. So one guy's ringing up, one bank, okay, we'll do 50 million, yeah, we'll do 100 million, we'll do 25 million, 50 million, 50 million, 25 million, 100 million, 50 million, 25, 30, 80, 60, and he's riding all the way up, and the ticker's just going down, 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 gets down to zero, and he goes clear and sits down. It's just gone dead quiet. And they'd clear this trade in about 2 minutes flat. I don't know how much money they made or lost on it, but it was done. It was quite remarkable, just like that. When I was on the floor, I was included in an experiment that was run by, I think, the Sydney Morning Herald at the time, and they wanted to test the stress levels of various jobs around the place. So I had an ECG put on me for 24 hours in the pit. A doctor in an emergency room had one put on, an air traffic controller and a couple of others. So in the pit, standing still, my heart rate went over 200. During this, they just happened to pick the most volatile day, and they knew it was going to happen. Back then, interest rates were about that 20%. So the market was swinging around backwards and forwards very, very wildly. So yeah, that was interesting. I've tried to hunt for that article and the conclusions and all that kind of stuff, but that was pretty interesting to have that done. We all hear about spoofing. Do you know what spoofing is? It's illegal now. Probably always has been. But spoofing is when you play with the market, trying to influence the market, and it's now done by computer. So, for example, let's say, and you see algos playing around in the depth, right? You'll see all these orders come in and go out, come in and go out, come in and go out. Spoofing kind of did the same thing. You just send all these orders in straight away and cancel them all straight away, trying to influence the price. Because people watching depth, they'll see 500 buy orders come in for this massive quantity, and you go, oh shit, I better buy, and they start buying, and all of a sudden you cancel it all, and they're left holding the rug. So we used to do it on the trading floor all the time. So back then, and I'll give you an example, I was working over in the 10-year bonds at this particular time, not in the pit, actually on the phones, and I had a client that a big hedge fund in the US wanted to come in. Now, in the SPY pit, a big order would be 100, maybe 200 contracts. That would be considered a big order. On this particular morning, I got a phone call from this guy in New York. He wanted to sell buy 5,000 SPY contracts. It's like, yeah, I'll just walk straight in the pit and go boom, 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 boom. That's not going to happen. So for the whole day, I would just quietly ring over to the advisor over there and tell him to buy 100 SPY. Wait 5 minutes, buy 100 SPY. Wait 5 minutes, buy 100 SPY. And eventually, what happened was everyone started watching him because he just kept coming into the market. So I'd wait half an hour, then I started signalling the orders direct from the other side of the trading floor to the trader over there. So we'd do that for an hour. Then people would start to pick up that it's coming from me. So all this went on all day, just, quietly, almost walking outside and making the phone call to do the trade, and all this stuff was going on. And then I would walk over and do some trades, and I'd call the bill trader to go over and do some trades, and we would just unload this order. Anyway, I think we'd done about 4,500. We had 10 minutes to go during the day. So I just started increasing the buying. And then in the last 1 minute, I just threw the last 250, 300 contracts into the pit market on close, just jammed the price right up to the high of the day. So basically what we did is made ourselves look like superstars because we've accumulated all this volume and then falsely closed the market right up on the day. Didn't go to jail for that one. This is in Singapore. And you've all heard of Nick Leeson. Right. So the story behind Nick Leeson, he was jailed just after I got to Singapore, and I was doing the exact same thing that he was doing. So it took me 8 weeks. I was told to come to Singapore, sit there, shut up, don't speak to anyone, don't do anything for 8 weeks. And Singapore completely investigated my whole background. They went back 20 years into my history to find out who I was, what I was doing before they granted me access. Apparently Nick Leeson had a driving infringement that he never paid off, and Singapore seemed to believe that if they'd picked that up, he wouldn't have been allowed and all this bullshit wouldn't have happened, whatever. Anyway, so what the background with Nick Leeson is, I'll be 1 minute, last story, is that he made an error, or someone in his company at Bearings made an error. And he decided to run the error for a little while. It got a little bit worse, came back a little bit for him, and he thought this is going well, then it started getting worse. So rather than just cutting the error, i.e. cutting the position, he decided to hedge it. So he hedged it using, instead of the Nikkei, he hedged it using the JGBs. And then they started going the wrong way. So he said, all right, well, what I'll go and do is I'll come into the Nikkei and start buying the Nikkei up and influence the price. So he did that, and that lasted about 1 minute, and then it started going the other way. Now all of a sudden his position in the Nikkei is even bigger, and it's going further and further away from him. And this went on for about 6 or 7 months. And his positions just got bigger and bigger and bigger and bigger and bigger. And all he would do is he'd be sitting there and he couldn't sleep or anything. And what he would do is he'd walk into the pit, and again, a big order was about 100 contracts. And he'd just walk into the Nikkei one day, out of the blue, and just go, 6 for 5,000, 6 for 5,000, and everyone just goes, shit, and just go bolting and start buying everything. And he'd just try and force the price up like that. Of course, as soon as he stopped, the price all fell back again. But what he didn't know was there was a guy in Osaka. Now, Osaka trades the Nikkei, and it's the exact same contract Nikkei that trades on Cymex. You can trade both of them and offset. They're exactly the same. So old mate called Goldfinger, why? He made 98% of the bank's profits that year because of Nick Leeson. 98%. And he was the most arrogant prick you've ever come across in your life. He seriously was. And he did all his dealing through us, and we employed one special staff member to look after him, and she would spend the whole day on the open phone to him. No one else, no other client, open line to Osaka from Singapore just to speak to him. And the way it worked was he would be on the computer terminal in Osaka, and we would take his orders in Cymex, and they would offset. So when you got idiot Nick Leeson walk into Singapore and start buying the crap out of the Nikkei, well, he would just sell it all to Nick Leeson here and be buying it over here and just lock in the profit. And he would just ride it to the end of the settlement and offset him and make all this money. And this just went on and on and on, and Leeson just got bigger and bigger and bigger. So he'd push the spread out and it'd come back again. He'd push it out and it'd come back again, push it out and come back again. And this guy in Japan, he couldn't lose any money. He was just making money hand over fist, risk-free. So all he had to do was sit there and wait for this dick Leeson to come out and do it again, which he did for about 6 or 7 months. And eventually Leeson built up massive positions, like hundreds and thousands of positions, and he started doing it in the JGBs, and this guy started doing the same thing. Easy as money as you can make. And eventually it all unravelled and Bearings Bank went under, and that was the end of the story. But old mate kept the money, and he got given the name Goldfinger. There you go.